Hello and welcome to Focus IR. I am John Human, and today I'm delighted to be joined by Jacqueline Broers, who is a senior analyst at Utilico Emerging Markets. How are you doing, Jacqueline?
I'm good, thank you. How are you, John?
Not too bad, thank you. Not too bad. And today we're gonna focus, because these are enormous subjects, on two megatrends which you specialise in, which are global trade and the energy transition. Not a lot of ground to cover there. It's absolutely vast. So perhaps we could kick off with talking about the demand drivers of energy consumption in the emerging markets that you look at. What are the key things that are driving the demand for power?
Well, first of all, I mean, look, if we go through at UEM what we identify as the four fundamental emerging market drivers, they're the easiest way probably of explaining, I suppose, what is the drivers of energy consumption. First of all, we've got like a lot of positive demographics happening in emerging markets. So we're seeing growing populations. And as we're seeing growing populations, we are seeing an increase in the energy consumption and therefore an increase in energy demanded. And the second one we always identify at UEM is urbanization. Again, as we're seeing a shift in urbanization or urbanization rates increasing within emerging markets, we are naturally seeing an increase in demand there because people are moving to cities. Then you need energy to construct the cities, the running of the cities, transportation networks, etc. As you urbanise, you also then typically see more of a shift to industrialisation again, and that requires more energy and an improvement in manufacturing and so on. So there's a massive demand for energy coming from urbanisation. Emerging markets also typically witness strong GDP growth, higher GDP growth, then also that links into more energy consumption. Typically we see if the GDP is around sort of 6-7 times, you'll see a sort of 1.5 times multiple coming through for energy demanded. So that's sort of the third driver coming through. Another one is the growth of the middle class. As these emerging market economies are shifting up, I suppose, the value chain, as we shift more people out of the working class into the emerging markets, into the middle class, you will see that their demand consumption for energy increases. They want cars, people want aircon, they want more electric equipment. Again, energy all increases. But energy consumption has sort of taken a bit of a change over the last few years, and that has been driven also by energy security. So that is not necessarily changing the total requirement of how much energy is required, but I suppose it's really changing the shift in the energy mix and the need for countries to realise that they need to be self-sufficient. And the Russian-Ukraine war recently, in sort of 2022, which is still ongoing, has been a real catalyst to push countries to look at much more sort of self-sustaining energy sources. And that's in a nutshell, trying to summarise what is going on, I suppose, with energy consumption at the moment.
There's a very interesting trend, and it's probably overlooked in terms of energy demand. I spoke to your colleague Mark LaBelle recently about the digital side of the economies in emerging markets, and obviously it's not something we necessarily associate with power demand, but the increased digitalisation of the economies in emerging markets is also, as I understand it, a very, very large source of energy demand.
Yeah, I mean, look. Yes, there has been increased digitalisation. I mean, if you look, for instance, at, ChatGPT searches, they require 10 times more energy than a Google search. So just that switch or utilisation or more, I suppose, investment into AI, which is then requiring data centres, which is requiring more power, there has been a huge shift and increase in demand in energy, definitely.
Yeah, massive, absolutely massive. You mentioned self-sufficiency as a very important factor in meeting energy demand in emerging markets. I guess the other important consideration here is the sort of cleanness, the greenness of this energy. Can you talk about how emerging markets are balancing the need for self-sufficiency, but with also the need to meet sort of net zero obligations?
Yeah, I mean, I don't really want to start with that one because every country is at a different position at the moment. Look, it's a big thing. Obviously, a big driver for a lot of the emerging markets. I mean, what is really clear though is that there isn't enough clean energy at the moment. I mean, it's been estimated, I think, that around 155 trillion US dollars is required to be invested in emerging markets into renewable energies between 2024 to 2050 in order for them to be net zero by 2050 and be in line with the Paris Agreement. And that magnitude of investment is huge. But all the different emerging market countries in which we look at are at a different point of that journey at the moment. I mean, China, for instance, is always depicted as the world's greatest polluter. I mean, 60% of its energy consumption mix is coming from coal. But the rest of it is, 16% from solar and wind, 12% hydro, and 9% natural gas. But they are really committed to trying to change that energy mix. By 2060, they are hoping to be carbon neutral. But they are cognizant of the fact that they are not going to be able to just turn off fossil fuels overnight. So they have said, they will reach peak carbon emissions by 2030. So therefore, what you're seeing is investment still going into coal in China, but they are making a massive shift towards the more renewables. But for them to reach their targets, they need to increase investment into renewables by 80% by 2006. And that's huge. And India's in a very similar situation. It's not as blessed as China with the mix of renewables as part of its energy source at the moment. Renewables is about 18% for these guys. But they also have, by 2030, they have said that they would trying to invest 500 gigawatts into renewable energy and 600 gigawatts by 2032. Again, that's huge, reducing fossil fuels from around 70% of their energy mix today down to 50%. But again, they can't just switch off coal overnight. So we are expecting investment into coal power plants of around 80 gigawatts, or thermal energy, I should say, of 80 gigawatts by 2032. And that is where we're sort of seeing the emerging markets sort of come out. I mean, Brazil is a different story. It's been blessed with hydro, so already it's got 85% of its energy source comes from renewables. So they've effectively lucked out just both the geographical nature of their country, but also in some ways their foresight of thinking. But when we look at energy, I mean, it's moving quite a lot. Generation is really dependent on support from the government. We've now got that. Governments are online. It's very dependent also on access to capital and how this can be funded. But two things have also happened within sort of renewable energy sector is that actually renewable energy has become much better in the sense that the technology has improved significantly. Solar panel will become more powerful and pricing has dropped significantly, which means that it's cheaper for especially the emerging markets to invest into these kind of energy resources. But one thing we've also got to consider is that great, solar's fantastic, but it doesn't always the sun isn't always shining, and wind, great, but the wind doesn't always blow. So what we're seeing is a mix of investment going into this sort of renewable, but at the same time we're having to substitute or provide a backup, I suppose. And a lot of these countries are looking for battery storage to go alongside solar and wind, but that isn't as cheap at the moment. So this is where you see the sort of the fossil fuels will still remain for a bit until we can really get that technology good enough to ensure that renewables are able to provide us with a 24/7 energy solution.
Yeah, I guess the other aspect to consider when it comes to energy is not just generation, but how it's used, the efficiency with which it's used. And I guess this is something that you would look at in terms of the other sectors and megatrends that you're looking at, particularly transportation and trade. I guess this is an area where energy efficiency can really transform those industries.
Yeah, I mean, look, within the trade sector, I mean, actually, well, with all companies, it's not just the companies that we invest in at UEM. I mean, all countries now are very cognizant of their carbon footprint, and many companies are now sort of putting out statements that they're going to be carbon neutral or carbon neutral by X date. And it's a big push, not only from the investor side, but just, I suppose, social awareness and moral obligations, I suppose, a lot of these companies. But within the transportation sector, yeah, there has been a big push. I mean, I look at sort of some of the port companies, electrification of all their cranes, which are then running on green energy. Airports are using solar panels, etc., to drive their energy sources. Railways are using clean energy as well to try and for the running of those services. Logistic companies trying to use EV cars where possible, or EV vehicles where possible, but for the longer distance using CNG, because EVs at the moment, the technology is not there for the battery length. And toll roads, yeah, again, solar or some form of renewable energy source where possible. So yeah, it is a big thing. And also outside the transportation sector, I mean, if you look at the digital sector, again, data centers are very cognizant of their energy consumption. I mean, they require a huge amount of energy source. So again, they're looking for renewable energy with a battery storage if possible, because they need to ensure they have constant energy supply.
Yeah, yeah. Do you think that, I mean, because a lot of the emerging markets are at a later stage of economic development, that this actually in some respects gives them an advantage when it comes to investing in this kind of infrastructure? They can sort of leapfrog the legacy technology and actually take advantage of what today is much better technology when it comes to these renewable forms of generation.
Yeah, I mean, if you look at, so I've just come back from India, for instance. There's been a big push, like I said, for solar and wind assets there. The pricing has drastically reduced, and the performance of these assets has improved, which has made it easier for these countries to afford investment into these assets. So yes, they have leapfrogged at the same time. But I mean, just to add, I mean, it's great they can invest all into this renewable energy, but one thing we have to always be cognizant of, and some of the investments that UEM absolutely love, is transmission assets. We can put a solar panel or a plant somewhere, or a field somewhere, but it needs to be connected to the grid, and that needs government support as well to auction transmission lines, ensure that investment is happening. So everything needs to be linked up, if that makes sense.
Yeah, indeed. Same in the UK. The National Grid's got a lot of building to do here. I guess, I mean, this is such a vast subject. So many moving parts. How do you at Utilico actually distill this down into something that you can practically invest in?
How do we distill it down? I mean, well, what do we look at when we make the investment? Well, at the end of the day, at UEM, we are bottom-up investors. We are looking for an investment return that we believe is attractive. So therefore, that is the fundamental driver of our investment. I mean, we're not an ESG fund, if that makes sense. So we can invest in fossil fuels if we think the return of that company that may be investing into that is sufficient for the fund. But look, we look at a number of different factors: what the cash flow is, what the regulatory, what the cash flow, basically what the asset is generating on a cash flow basis, what the return of that asset is, but also what the regulatory environment is. Is it supportive for investment into that stock? Also, what the government policy is towards it. Because what we don't want to happen is we invest into, I'm trying to make an example here, an investment in China where sometimes the government policy can change overnight very quickly, and then the investment return that we thought we were going to get is now diminished rapidly overnight. So we have to make sure that we can get comfortable, I suppose, with the structure or the governance, I suppose, of the country in which we're investing in, as well as what the outlook is.
So where does this take you in terms of the kind of investments you're making? Perhaps give us some examples of the strategy in action.
Well, recently, I mean, we've been increasing our position. Again, I talk about India quite a bit at the moment, but in a company called IndiGrid. That's it's quite a unique structure in the sense that it's a investment trust. So it's slightly different in the sense that assets are put into the investment trust, and therefore it's a tax efficient structure because they have to pay out 90% of cash flows. But IndiGrid is an investment trust that has currently 8,700 kilometres of transmission lines, and it also has 1.1 gigawatt of solar assets. And this company is providing us, because they're transmission assets, we've got clear visibility on the tariffs in which they are, or the tariffs that they're earning. So we've got visibility on that. We can see there's long, stable cash flows coming through from those assets. The solar assets are also under PPA contracts, which means that the energy they get produced at gets a fixed price. So again, you know what it's going to be. So you can model out quite easily what the investment return is on a company like this. And because it is it's what we call an INVIT, it's the infrastructure trust fund structure. It's paying out 90% of its net cash position, and that's given us around about a 10% yield, which is really attractive. And the trust is incentivized to add or acquire new assets to go in. And increase the dividend per unit for shareholders. So it's a stock which we like quite a lot.
Yeah. So really, the sort of nuts and bolts of the infrastructure that's driving the economic growth in these regions. We've talked a lot about energy and the sort of complexity behind the transition that emerging markets are facing. There is another factor which we've sort of alluded to when we've talked about transportation on the global trade side, which is this idea of deglobalization, nearshoring, onshoring, the sort of trade flows moving around. Can you tell us a bit about your thinking behind this, particularly in light of the sort of energy security and security of supply that many are looking for at the moment?
Yeah, and look, I would say, well, on the energy side of things, I would say nearshoring. I mean, look, countries are looking to become self-sufficient in their own energy sources. That's I think is very evident. But on the global trade side of things, when we look at nearshoring and sort of offshoring or friendshoring or effectively whatever you want to call it, I mean, it's really difficult, I think, at the moment to read through the noise that we're hearing from Trump 2.0, and what actually that would mean. I mean, is he going to put 60% tariffs on China, 25% on Mexico and Vietnam? Who knows at the moment? Is his bark worse than his bite? We don't know. But what we do, I suppose, at UEM is look, we've been looking for opportunities that can benefit from any change, I suppose, in global supply chains. Look, emerging markets, by 2040, their percentage of global GDP will exceed that of developed markets, which is showing you just the importance of emerging markets in global trade. Countries aren't going to stop trade. I mean, the US isn't going to stop trading overnight with China. China still remains a huge part of the US volumes. But what has happened, I suppose, is the shifting of trade. So yes, China is no longer trading as much as it used to do with the US, but actually, in absolute terms, its trading volumes has increased because and what you're going to ask, where's it gone? Well, it's gone to ASEAN, it's gone to Vietnam, it's gone to the Philippines, it's gone to neighbouring countries, and then actually what you can see with Vietnam is that actually its exports to the US has increased. So it's kind of just shifted. Who's the winner of this? Mexico at the moment, or has been the winner. Let's see what Trump does. But I mean, Mexico is now overtaken China, the biggest. Is the US's biggest trading counterpart. So it's at the moment it's difficult to see what is really going to happen. But look, there's always going to be an opportunity for us to find an investment somewhere, and the companies in which we invest are diversified enough to be able to ride that storm quite well if it arrives.
Indeed, and ports and shipping are a big part of the investment portfolio at UEM. And I guess what you're saying is that there will always be a need for ports and shipping wherever things are moving from and to.
Yeah, I mean, look, the port exposure that we've had in the portfolio, I mean, it's actually number 2 in the portfolio, but International Container Terminals, it is a Philippines-listed port. It's been in the portfolio ever since I've been at UEM, so over 14 years now. But it operates 33 terminals in 20 countries, all over the emerging markets. So it's an incredibly diversified port operation. So if we see volumes going up one place, usually actually it benefits somewhere else. But I think what we always look for in port operations is what we call origin and destination ports. So at the end of the day, there's going to be a consumer that wants product. They want a good. And if you've got an origin and destination port, volumes still have to go in and out. There's still going to be demand for those goods. So an ICT very much plays that, and these guys have been fantastic at adding assets into their portfolio. And what they've been great at is ripping out excess costs of poorly managed ports, I suppose. And as we see volumes increase, the operational leverage improves in these operations. And then we've seen a huge increase in EBITDA. I mean, volumes, I think EBITDA over the last 5 years is up 81%, but volumes is up 21%, which is just 25%, which is illustrating to you that operational leverage that is coming through. And then EBITDA margin is now at 65%. So yeah, it's been a solid company for us to be invested in.
Yeah, plenty of opportunity out there despite all these moving parts in the background. Jacqueline, I think you've done a fantastic job of taking these two vast megatrends and helping us understand them very clearly. Thank you so much for talking to us today.